You're watching Beyond Markets. Welcome, I'm Esther Awuni. Many thanks for joining us. On the show today, we'll be assessing investment options in Nigeria as the pre-election season kicks in. As always, you can join the conversation with the hashtag Beyond Markets. You can send tweets to my Twitter handle too, at Esther Awuni. Now, the second half of this year in Nigeria will see pre-election activity hit full swing. But how can investors position at a time like this? Michael Oyebola, Managing Director of Chapel Hill Denham Management, joins me for this discussion. Michael, thank you so much. Pleasure to have you on the show today.
Good morning. Pleasure.
So, interesting times at our markets, interesting times for the economy, and of course for politics. And now, I dare say that politics has taken full swing and it's taken the front burner, as it were. But it's also a time when investors begin to ask themselves, how do I approach the Nigerian market? How do I engage in the Nigerian market? Where are the safe, with all this uncertainty at in the political scene, where are the safe assets for me? How can I protect my investment? At the same time, get good returns. What are your thoughts?
For every investor, it really depends on what your investment objective is at the end of the day. For those who are in retirement or about to go to retirement, then you're better sort of just in the fixed income instruments. Those currently, Treasury bills, you'll find around about 10%. On the long end of the curve, slightly about 11%, and federal government bonds around about 13–14%. So if you're looking for income, then you're better just around that. Now, however, if you're looking for a shorter term, there are a number of commercial papers that have actually hit the market and continue to hit the market. I think Lafarge WAPCO opened yesterday. There are some more on the horizon. But if you're a long-term investor, you should always continue to balance your portfolio within fixed income and the equity market. We're in the reporting season, or second H2 reporting season, Q2 reporting season at the moment. A number of results have been released from both the financial services sector and other sectors on the Nigerian Stock Exchange. They're mixed. We tend to view the markets at the moment as opportunities to buy when everybody's either gone on holiday or actually not looking, in anticipation of possibly Q3. There are a number of corporate actions that may come out of the financial services sector. But whole and whole, the market itself, I think, was down 1.09%, 1.09 points yesterday. It was down 4.02% over the over half year.
It's still down for the year, and I was taking a look at all the key market indicators, from oil and gas to industrials, consumer goods, are all actually down year to date. But I wanted to, you mentioned the half-year earnings, and you said the numbers were mixed. I wanted you to also expand on that. When you took a look at those numbers, what did those numbers tell you about the state of the economy, or how the operating environment is treating those companies?
The operating environment for the companies is still a bit tough. Consumers are still being stretched. Inflation was gradually coming down. Food inflation is possibly the one that actually hits most people in the pocket. Yes, we're entering the harvest season at the moment, where food prices may moderate. But generally, I believe that the consumer is still stretched. Yes, Nestle, for example, released very good results at the end of the day. But the consumer generally is still stressed. So when you look at companies like International Breweries, they posted a loss before tax and a loss after tax. Nigerian Breweries still has a number of challenges, even though the products are out there. Guinness Nigeria still the same. So it possibly still shows that the consumer is still stretched in their funding and financing.
And this is a safe haven, because consumer goods is meant to be a safe haven sector for, or at least traditionally, it hasn't exactly played that role in.
Yeah, but if you look at the statistics coming out of the Nigerian Stock Exchange, you possibly find that over the last 3 months, the largest trading block within there have been financial services. So you do find that possibly mentally, people presume that the safe haven is more in the financial services sector. But why won't it be? You and I put money in a bank account and we try to take our money out. So what we tend to say is, look, have a diversified portfolio, but you need to continue to monitor the markets. Now, if if, for example, there haven't been that many new listings on the market, so we're possibly still recycling the same stocks. And investors possibly need to start looking at alternatives, right? Whether it's in infrastructure, whether it's real estate. And if not, then keep some aspects into the equity market, but also look at the fixed income market.
Okay, I wanted us to take those investment options one after the other. While we're on the equities markets, let's quickly talk, firm that up. For the equities markets, looking across the sectors, obviously financials,
yes,
the banks, especially
yes,
perhaps the tier ones, would be a good place to go,
yes,
right? I want us to just take it from there. So for you, what the banking sector, what else can investors look for? Those who are holding that long-term view for the equities markets, because obviously it's not for the short-term guys, especially at a time like this.
Okay, so you're saying outside the financial services sector? Because
outside, yes,
possibly even within that financial services sector, outside the banks, and even if you're choosing the banks, you need to be very, very selective. So whether you're going to go for the large cap, mid cap, or small cap, and if you're going for the small cap, whether you're prepared to take that risk, because it's more hurting to your portfolio investing in a stock which is 1 naira than investing in a stock that is at 40 naira or thereabouts. Now, as you possibly heard earlier this week, insurance companies are meant to recapitalize. In a normal market, you will find a number of investors taking positions there as to, okay, am I going to be hit with a rights issue, or am I just comfortable with the existing configuration of my portfolio in some of the companies that will be in tier 1, in tier 2, in tier 3. Outside the financial services sector, if you're a long-term investor, the food and beverage markets, consumers, is still, look, we all have to eat at the end of the day. So if you're looking, whether it's flour, whether it's in terms of food and beverages, you can look towards that. Infrastructure, when you look at infrastructure, whilst a number of companies can provide you access to the infrastructure, whether it's in terms of cement or whatever, you also have to be careful, because when you look at a Lafarge, for example, coming up with another capital raising activity,
and a loss
that's been there. So financial services, food and beverages, the cement sector. Outside that, I think we actually struggle a bit, because it really depends on your investment horizon as to what you actually want to do.
So what is the best bet? Because I guess let's start from the point where, for now, Nigeria's equities markets, you're better off if you're a long-term investor, right? If you're holding a long-term view. Am I right, or am I wrong?
Well, no, I can't put it completely that way, because you have to look at the opportunity cost of your funding. Now, if, for example, you buy a treasury bill or a fixed income that is going to provide you, I don't know, between 10 and 14%, whether it's a treasury bill, a CP, or a bond, and you're compounding that maybe every 90 days or every 120 days, or in the case of a bond, you're holding a bond to maturity at 14%. You're getting your coupon and you're reinvesting that coupon. You have to take it from the flip side, that if you put that money in the equity market, right, you have a choice of, no, the market gives you a choice of two. You're either going to make money, right, by capital gains, or you're going to lose money, capital losses. In between, you'll have your dividends. Now, dividend yields on a number of stocks within the financial services sector possibly are ranging anything from about 6 to 10%. That dividend yield is not guaranteed. Whereas if you invest in fixed income, you will get your coupon. But then parlayed on top of that inflation. Right? So by the time you knock off inflation from that, those are the kind of decisions you have to take before you can make that final decision as to, am I better in the equity market? Now, if as a portfolio manager, I'm running an equity fund, then I don't have a choice. I have to invest in equities. Now, we do have it occasionally here whereby, just to support the portfolio, some invest in fixed income. But naturally, if you call yourself an equity fund, you're actually meant to be investing in the equity market.
Let's move over to the fixed income, because I know that, it's obviously still a safe haven backed by the sovereign, so you have less risk there across the treasury bills, bonds, the green bond, the savings bonds. And it looks like, we're having more options now, the savings bonds, the green bond, and of course, corporate bonds, state bonds. But in the last for the beginning of the year, we did see yields at a good level, but we saw that dip I think in Q1 as the federal government decided to pull back because of pressure from debt service and to just give the corporate sector more space to invest, as it were. But, you know, at a point, it looked like the yields were going too low, and the CBN had to say, you know what, we need to keep our hot money, we need to keep the FPIs, who were already taking, you know, sitting on the fence or just taking their capital out, we need to keep them interested in our market. So we saw those yields go back up. And now we're going into this election cycle, and I know that those foreign portfolio investors will get even more jittery, especially now that it looks like we're not sure the political calculations that we're seeing on ground. I'm sure you've seen the newspaper headlines on a daily basis. You cannot plot to say who's going where, who's where, or what's going to happen. It's so difficult right now. Yeah. So the foreign investor is probably saying to himself, look, I'm not sure how this puzzle is going to work out, but one thing I know for sure is I don't want to lose money. I'd rather take my money out than lose it. So for that category of investor and within the fixed income market, what's the play?
For a foreign investor, and I'm not one, but it really depends on the category of that foreign investor. Now, if you're getting interest rates sub 1, sub 2 in your jurisdiction, and FX rate has been stable, and you're coming over here and you're getting 12%, you then take off inflation, and you're possibly going back with about 3 or 4%, you're still doing double what you would have got in your own jurisdiction. But as I said, it really depends on that kind of investor. If you're a hedge fund, for example, who has to deliver an annual pickup or an annual yield or an annual return, then you might be okay. If you're an emerging market investor, then you're possibly looking at things totally different, because you will have an allocation to emerging markets, then you bring it further down to maybe Africa, Asia, and whatever, and your allocation to Africa may then consist of maybe around 30 or 40% in Nigeria. You will look at it from a point of view that do I do equities or do I do fixed income? When you look at the fixed income market, you possibly say that, okay, last year yields were between about 18 and 20 on the yield to maturity 2022, but things have actually pulled back much more since then. And you sort of say that, okay, if I buy a 1-year treasury bill at about 11.5%, 12%, 12.05%, then am I better at doing that? Possibly, yes. There are a number of CPs which are slightly priced above the treasury bills. You will do your analysis and check out the rating of the organization, the ability to repay, whether they're going to refinance it, the ability for the liquidity at the end of the day, and you may look at that. So your options, whilst they're not limitless, they're actually, you do have a variety of options, and depending on the sector as well. A number of them have come out within the financial services sector. Banks are actually issuing a number of CPs. FMCGs are issuing a number of CPs, as I've mentioned. So
looks like the CP market is a lot vibrant now compared
from where we started in 2008, when the market completely froze up, to about 4 or 5 years ago, when it actually started building up. The market is actually getting deeper and deeper, and investors have now gotten used to it, that every other week there is one CP or the other coming out into
All right, Michael, we'll take a quick break and we'll come back and pick up from where we left off. Thank you for your time so far. I've been speaking to Michael Oyebola, Managing Director, Chapel Hill Denham Management, looking at investment options right now in Nigeria, of course, as we kick the 2019 election season kicks in. We're continuing our focus on investing in Nigeria ahead of the 2019 election. Still with me is Michael Oyebola, Managing Director of Chapel Hill Denham Management. Michael, thank you for your time so far. We're talking about commercial papers. We've talked about the equities markets and how safe, risky, or how investors can just diversify their investment portfolio. Let's wrap up the commercial papers. We're talking offline how we're seeing more corporates issuing commercial papers. I mean, looking at the interest rate that we usually get from a bank, it's obviously higher. So CPs might be the way to go. Your thoughts? It
is. When banks are still charging corporates, and it takes a much longer time than a CP, or between 20 and 22%, even though some of them have started repricing lower. A corporate would prefer, I mean, if there's 800 basis or 80 basis points between what you can get on the market at 12% and within a bank at 20%, then you will go for the CPs. So that is why a number of corporates are now accessing the CP market, which tends to be a bit faster. A majority of those issuing now are A or AAA rated organizations, and so the risk of default is much lower. There's a possibility that the moment we start going further down the scale into B, triple B, and so on and so forth, we might start getting a different market. But right now, the market is buoyant. As I said, we've come from zero to where we are today. A huge number of, there was a CP last week which was oversubscribed, and the issuing house had to scale a number of people back. And currently, because of the yield environment where we are, there's a lot of chasing the yield. There's a lot of investors chasing yield, because when you're getting 90 days on a treasury bill at 10% or sometimes even lower, and you're getting the same on a CP of about 11, even sometimes 12% for a 90-day, or if you go as far as 270 days, you're getting it at 12.5%. Then you find a number of people chasing that yield.
So do you think that for fund managers who are pricing mutual funds, are they saying to themselves, okay, maybe I can just scale up a little bit on my CP part of my portfolio just to make up for the loss on?
Yes, they will get a yield pickup because, for example, money market funds which possibly didn't have or had a minimal allocation to CPs or other investments outside treasury bills have started increasing their asset allocation towards that. Now, if you're, and for a money market fund, your weighted average maturity cannot exceed 90 days. However, even though you can still go as far as 364 days in instruments. So what you will find is that if you curtail yourself towards that 90-day, your yields will definitely be around the 10.5, 11%, but you can get a yield pickup by going and buying some of these CPs. Another for a balanced fund, for example, they are possibly also increasing their asset allocation towards that. An equity fund may struggle, even though some equity funds still have allocation towards fixed income, but a majority of where you'll find this will actually be in the money market funds, where a lot of investors are possibly pulling their money out of savings accounts because within a saving account, you're basically just getting 3% less withholding tax. But in a money market fund, yields range between 10% up to about 11.5%.
Do you think that more and more Nigerians are getting, beginning to realize that, or getting more savvy, as it were, within the investments? Because there's a time when, and I know that there's still so many people out there who do not know that, that if they take that money out of the savings account, they can actually make profit elsewhere. Do you think that there's a growing realization of that?
There is, and I think the message is getting across, because you will find that the message possibly being pushed from the Securities and Exchange Commission, as well as the fund managers, as well as the Fund Managers Association of Nigeria, is that where would you rather put your money? Would you rather put your money at 3%, or would you rather put your money in a money market fund? And a money market fund is effectively regulated by the Securities and Exchange Commission. It's run by fund managers who are regulated by SEC and give you 3 or 4 times what you would get in a savings account. The pullback occasionally tends to be, and this is where a number of fund managers have to get their processes right, is that in that savings account, you can take your ATM and go to the ATM and get your money out instantly. Whereas with some fund managers, it possibly takes about 3 to 5 days to get your money out. But if you plan well, that should not be a problem. But there are fund managers out there that if you submit a redemption request today, you possibly get your money the next day, if not the same day in some instances.
Now, so as an investor, looking across the equities market, as a fixed income market, where am I better off? I'm taking a look at the mutual funds, where I have a more diversified portfolio, where my fund manager can put my money in at least 3, 4 different places at once, compared to just being a single investor at fixed income or the treasuries, bond or equities?
If you're an individual investor, my recommendation would always be that you use a mutual fund. From the point of view that you've got your day job, do you really want to be monitoring what goes on in the Nigerian stock market between 10:30 and 2:30 every day? Do you want to be monitoring the treasury bill market between 10 o'clock and 2 o'clock every single day? Let a fund manager do it on your behalf. And you're absolutely right. The money you have goes into a mutual fund, and it is spread across a number of asset classes or a number of investments. Whereas, depending on how much you have to invest, you may just be looking at one or two investments. And if anything happens the way you don't want it to, then you might actually be kicking yourself. So ideally, you're better using a mutual fund, and you can get a number of mutual funds, from pure equity mutual funds to pure money market mutual funds to balanced mutual funds to infrastructure mutual funds to real estate mutual funds, or in certain instances, you can have exchange-traded funds, ETFs as well. So the opportunities are there for the individual investor. For the institutional investor, they possibly have a research department, a fund management department who can actually look at these things. But purely from a retail perspective, my recommendation is currently for people to use collective investment.
Okay, I want us to move to the other alternatives investments, infrastructure fund. But quickly, I want us to talk about the real estate fund. I mean, looking at the real estate market this year, for those who are still interested, or maybe first time investors were looking at the real estate sector, how would you say that's performed so far, and what are the upsides or downsides to it right now?
Currently, with the view I've seen with the real estate market, there's a bit of a challenge because there are competing instruments for those funds. If you as an investor take money and go and buy a flat, for example, and you rent it out, your yield is between 4 and 5%. Whereas you can take that same money and invest in a treasury bill. Now, to some of us, it's a no-brainer. Why would I take that money and invest in real estate? Now, to diversify your portfolio, then you're possibly, if you're looking at it that you don't need the liquidity, then by using a real estate investment trust, right, or a property fund, and there are possibly just 2 listed on the market, with a number of other ones coming onto the market very soon. But from that point of view, if you want to be a direct investor, surely they do say it holds value, but the cash return you get from it is possibly not going to be anywhere near where you possibly want it to be right now. But also the liquidity requirement. It takes a long time to sell. It's a shorter time to buy a property in Nigeria. It's a much longer time to actually get out. So if you really need to look at your portfolio to see what your liquidity requirements are likely to be before you dabble and go into it. If you're looking at it as a home, then it's not really an asset, it is your home. But from a point of view from investments, then either use a professional investor to actually do that to diversify your portfolio. Okay,
let's look at another alternative investment, infrastructure. How lucrative is it right now?
Look, we keep talking a lot about infrastructure deficit, and within PENCOM investment rules, they've allowed infrastructure funds to come on board. It's more risky for an investor to do a green, sort of brand new investments in infrastructure. However, there's a starting point where we have, there's an infrastructure fund on the market at the moment called the Nigerian Infrastructure Debt Fund, which benchmarks its yield against the 10-year bond. It gives you anything between 350 to 450 above the 10-year bond, and is actually reset every quarter. It invests in infrastructure projects which are currently generating cash, and to even ensure that the investment is secure and the investee companies are there to pay. There's a debt service reserve account which they actually fund every quarter, and it is out of that interest is used to fund their quarterly payments. The interest rate is reset every quarter. Currently, the fund that exists currently pays out every quarter. The size is currently 11 billion. I think in the next 2 to 3 weeks, it should actually be slightly under 20 billion. The yield on it so far, it was launched last year. The total return to July this year was close to about 17%.
That's not too shabby.
No, it's not. Because at the end of the day, as I said, it benchmarks itself above the 10-year bond. So when interest rates are rising, you get 3.5 to 4.5, 450 basis points above the 10-year bond. Now, if you're a fund manager running a portfolio, and at the moment, it's actually targeted towards institutional investors. Just because of the nature of it. And so if you're an investment manager and you have to run a diversified portfolio. There's an infrastructure fund, which is debt as well. You still have your federal government bonds, your treasury bills, and so on and so forth. And about 50 or 60% of that is currently targeted towards the power sector, even though it's diversifying along the logistics line, along other avenues at the moment.
Michael, thank you so much. It's been a pleasure having you on the show today. Thank you for your time.
Much.
Michael Oyebola, Managing Director, Chapel Hill Denham Management. That's it on Beyond Markets. Thank you so much for being a part of it. Remember, you can watch all previous episodes of the show on our website at cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets, and you can follow my Twitter handle too at Esther O. Awuni. For myself and the team, do have a great day.